Hey everybody, today is Friday, the 7th of December 2012, and this is Brian Shannon from alphatrends.net. This week we saw kind of mixed markets. The S&P 500 was pretty flat here, just up 0.18%. NASDAQ was down 1.3%. A lot of that had to do with the decline in Apple, which we'll take a look at. And the semiconductors and financials had a good week, although semiconductors up to that 32.5 level, that's been important resistance, and the financials actually broke some important resistance. So let's take a look at the action here. The S&P 500, again, up just 0.18% this week, but I think it is constructive that we did close above the 50-day moving average. Now, the 50-day moving average is declining, so we have to keep that in mind, but we do have a nice higher low that was put in this week as well. The Fibonacci level that we were talking about was based off of the September high to the recent low in mid-November, and that came up right about, well, to 143-ish, and that's where we've seen some prior support as well. This 143 to 143.5 has been important prior band of support and then turning into resistance. Well, the bottom band actually is at 61.8%, and we got right up to that level initially on Monday, backed off a little bit, and today we closed fairly strong. We had a gap higher, of course, today. They got right up to daily R2. So again, it's important to look at those pivot levels throughout the daily sessions, in particular if you're a shorter term trader. But we did finish above the volume weighted average price for the day after that initial pullback from the volume from the daily R2. Anyways, back to the daily time frame. Let's just clear this up a little bit. We know our levels. We've got the declining 50-day moving average, but we found support along a rising 10-day moving average. So we still have mixed messages, and that comes often at turning points. So it's possible this market is readying itself to turn back higher. We do have, as we've been mentioning, this inverted head and shoulders pattern that's been forming over the last month or so, a month and a half really, if you take it back to early October. And these are 65-minute candles, by the way, which are better than 60-minute candles because there's six periods each day from 9:30 to 4 of equal length of 65 minutes, whereas 60-minute candles, you're going to have 7 candles, and one of them is really only going to have 30 minutes of time frame. Anyways, there's under the favorites of alphatrends.net, there's an article about that. Stop using 60-minute charts. Let's take a look at this though. We have the 5 and 10-day moving average right here. That's the red and blue, and we've got this resistance up at basically 143 to 143 and a half, that if we break that, officially I think we can look at our neckline right here at about 142 and a half. So if you're looking at this inverted head and shoulders pattern, here's our most relevant recent higher low. So we would actually take the height of this pattern, which is basically about 135, up to the neckline at 143. We'll just be conservative, so 8 points. Add that to the breakout point of 142 and a half, and this will give us a price objective of 150 and a half. Now, I don't think that's realistic at this point, not yet. We still have a lot to prove, but that's just something to show you, textbook technical analysis, what to look for potentially, and the possible upside that could be at hand in this market. It can happen, but as we've seen with some of these other inverted head and shoulders patterns, we were actually, the Russell 2000 was a great example that we had spoken about at length over here, that this inverted head and shoulders pattern had given us the measured move objective of the height of this, so 73 up to 82, so 9 points from this breakout range of 80. Should have seen, if the pattern had completed itself, a move up to 89. Well, this is why we want to be aware of those technical patterns, but we don't want to adhere so strictly to them. Instead, we want to say, well, as long as the pattern is higher highs and higher lows, we'll stick with that pattern. But when it breaks down and we see a lower low, we've got to move to the sidelines. So back to the S&P 500, it looks like that's the potential of what's setting up. This week, we did see kind of back and forth along that 5-day moving average, and I think as long as we hold last week's low or this week's low of about 140 and a half, even I think 141 and a half is reasonable to think that we're going to want to see that hold, especially if this market can break beyond that neckline. Then that will give the benefit of the doubt intermediate term to the buyers, but still be just a little bit suspicious that maybe the market needs more time to correct because of the declining 50-day moving average. So if that sounds wishy-washy, That's what the market is telling us. It's giving us a wishy-washy answer here. We don't have a nice trend that's confirmed on multiple time frames. So we have to recognize that the market sends us mixed messages, and we can still plan our analysis and look for the certain scenarios, such as the inverted head and shoulders pattern to pan out. But then we have to say where would our stop go if we were to get involved, and where would we have to change that plan in change our outlook for the market. The Nasdaq, again, it was down 1 point. What did we say? 2-3% in here this week, 1.3%. And again, a lot of that had to do with Apple. But if we take a look in here, we can also throw the Fibonacci. It doesn't really help us much here because we're not near a relevant point. But we retraced a little bit more than 50% of this sell-off, and we got up to the declining 50-day moving average. Now, earlier in the week, I was saying it would be good, or actually this was last week, that it would be good to see us move up beyond that 50-day moving average and just beyond the 66 level where we've seen some resistance, and then begin a pullback, which could form in a right shoulder that could go along with this inverted head and shoulders pattern. That is the left shoulder and the head here. So it's doing what I was hoping it would do. That is to find the resistance up near this declining 50-day moving average, to pull back. And I think that as long as we hold this level in here at about 64, that is where the 20-day moving average is, then we have the potential that we're setting up for a bigger break beyond 66.5. And again, the price objective here would be the height of the pattern. We'll go very conservative and call it 62 to 66 and say that it breaks 66, that it should be heading for about 70. And 70 is, we've seen this market at 70 earlier this year, and we still have the weekly pattern of higher highs and higher lows. So it's reasonable to think that that's possible. However, is it likely is another story, with its largest component, Apple, having such a rough week. And we started out the week last week saying that if Apple broke below 573, that would be a good place to set a stop because we would be below a declining 5-day moving average when we would have taken this low out. Well, it got the snot kicked out of it in here. It bounced back a little bit it bounced back pretty good on Thursday. But today, after that gap higher, it sold off back again. And for the week, the volume weighted average price in Apple, we fell short of that in here today. So near about $550 a share. Again, the weekly time frame, what we were talking about last week, was a bigger potential scenario for a bigger bigger head and shoulders top. And I don't mean to keep throwing out all these head and shoulders. Trust me, I'm not a big fan of any particular pattern. What I prefer is to be aware of the potential patterns and then look at multiple time frames to say, is that reasonable? Anyways, here's a left shoulder, here's a head, here's a right shoulder taking form, and down near about this 510 level, I mean, the height of this would be 200 points. Do you think Apple could go to 300? It's a stock. Stocks can do anything. They all go through the life cycle of big advances and big declines, and this would definitely be a big decline to get it down to 300. I think it's possible. I don't think it's likely, but we have to look at the evidence as it comes, because obviously there's going to be many 50-point moves between now and a move to 300, if a move to 300 were to occur. But right now, we've got the declining 5-day moving average, we've got a declining 50-day moving average, which we fell short of this week, and right into that prior level of importance here that was resistance and then support over here. So Apple looks like it just looks like a beat up stock that's going to need time to heal. It's shown some amazing volatility. I would expect the volatility to kind of simmer down a little bit before any future move. And by the way, I talk about every single day in Alpha Trends, which is a subscription product some people may not realize, but every Friday I bring you this video for free, courtesy of Realtic, which is the trading platform that I use, and what I look at all these these charts on multiple time frames, so check them out. But on Alpha Trends, I talk about fresh trading ideas every single day that are meant for swing trades. So we're looking for the action point based on a swing trade, and then the managed risk, and then it's up to each individual subscriber to determine whether, if you're in the chat room, we tend to do a little bit more day trading, or if you're just logging in at the end of the day, or the midday video that comes every day, that the swing trade setups and stops are adjusted in there. So if you're not member of Alpha Trends, you're viewing on YouTube or on alphatrends.net, then come take a look at a free trial for a couple weeks. Anyways, back to the markets. Let's take a look at the Russell 2000 because the Russell really held up well. It held above this declining 50-day moving average, and we had a very tight range in this market this week. It looks like it's really kind of building a little bit of a launching pad here. What I was looking for earlier in the week was the same thing as the Nasdaq, which was maybe a pullback down further, down towards about 81 to create a right shoulder, and then they'll go up and break beyond this resistance at about $83. $83 has been an important level of resistance up to about 83 and a half. This prior band of support and resistance in here is an important area for the Russell. When we take a look at the weekly time frame, it's kind of more sideways, I guess you could say, in here, but we have these higher highs, and this is an important higher low. That if we rally up to 85 and then break down below 75, the trend will have changed. But that's way ahead of where we are right now. There's no reason looking for that type of reversal, especially when the market is giving us positive reinforcement from price action in here. If we take a look at the Fibonacci in the Russell, that you can see from the highs just in September to the recent low, we've retraced just about the same as the S&P, that is 61.8%, and that 61.8% in this case turns right into the neckline of this inverted head and shoulders pattern. The height here is about, let's just call it 9 points. So a break beyond 83, add 9 points to that, will get us to 92. I don't think it's likely. I don't think it's really reasonable, but you never know what's going to happen. Perhaps we're setting up for a huge move in the Russell 2000. But before we can think that far ahead, we have to say, what about right now? What are our important levels? Well, we've seen that this market is holding on above 81 at 81.30. If we break back below 81.30, I think there's going to be trouble for the Russell 2000, and you're going to see it back down at least towards $80 a share, and possibly lower than that. So be aware of this important area, and start to get a little bit more cautious down near about 81 and a half, but breaking 81 and a quarter, I think, could be trouble for it. And we keep getting, we got up to 82 and a half a couple times this week. Both times they occurred on gaps like we saw this morning. So we saw a gap higher on Wednesday, another gap higher today. Those gaps were sold into, and you have to remember that on Monday we had a gap higher as well, or that this was last Friday, I suppose. Friday, Monday, Tuesday, Wednesday. No, that was Monday, Tuesday, Wednesday, Thursday, Friday. So 3 days this week we saw big gaps on the open in the Russell, followed by immediate selling, and actually we saw immediate selling on Monday, Tuesday, Wednesday, Thursday, and Friday. However, the market continues to close well, and we have these slightly higher lows. So I think breaking above 82 and a half and holding above there for a half hour or so could set us up for a break of that $83 level. Then our first objective would be maybe near about 84 and a quarter, 84 and a half, and then we can start to see if the market does behave well. That is, if it rallies up to 84, then pulls back to 83 and a half. If it starts to make that stair-step pattern, then we can think about some of those bigger price objectives of $92 a share. But for right now, you have to take it just as the market gives it to us in little bits and increments, and determine which time frame you're trading on. For me, again, I speak from a time frame of basically a swing trader's time frame, and where would the important moves set up? Because above 82 and a half and holding there, I think that the rising tide does lift all boats, and that the Russell 2000 could help bring a lot more strength into this market. Semiconductors, as we've been noting this 32 and a half level for quite a while. The market's done, gotten up to this level a couple times. It's been support, it's been resistance over here, back to support, and then resistance. We got slightly through it today and closed just below that level. When we look at the weekly time frame, we're still kind of just doing a whole bunch of nothing here. We've got this longer term trend line, which is interesting to see. And we had been talking about earlier, a couple of weeks ago, that a test of 30 looked likely. Instead, the market turned higher, and it's still in this big mess. So I don't think there's a lot of advantage to be trading the semiconductors. However, some of the semi equipment manufacturers are starting to look good, so, like Lam Research. Well, Maxim got a little hit a little bit hard towards the end of the day, but Xilinx, those are some good ones to maybe take a look at. The big group, though, this week of significance was the financials. The financials, again, what were they up? They were up on a percentage basis. These financials were up 1.7%, and that's a big move because especially when you look at the important levels that we've been kind of fighting. That is the 1585 level. At 1585, we've been battling this 50-day moving average. Well, we got above that 1585 level yesterday, and it held. That is, we broke above it and it tested it. That resistance became support. And now we've got an important area right here at about 15, let's just call it 1580 to give it a little bit of benefit of the doubt to wiggle back down a little bit. But we've got this prior resistance holding a support, and we've got a rising 5-day moving average in there. So I think getting back below 1580 would be the reason for concern. But until it does so, the trend in the financials is innocent until proven guilty. This becomes an immediate level of interest, closing this gap up here near about $16.15. This week we saw, Citigroup had the news of the layoffs, and they did really well in here. The better one, in my mind, was the one that we were long in Alpha Trends at 997, was Bank of America, which broke this resistance here on that same day and had a chance to be purchased. And this Bank of America, though, if you look at the weekly time frame, has a much more bullish look, I think, than Citigroup because it's broken a multi-year level of resistance, and it's now looking like Bank of America is likely headed for about 11 and a quarter or so. But anyways, that's the financial market. The financials had a good week. As long as they remain above 1580, I think you give the benefit of the doubt to the buyers in there. People like to talk about gold a lot, and we were talking about in here the potential also. And again, I'm not a inverted head and shoulders fan. I don't look for these. They are just, you look at what the market gives you. And we were talking about a right shoulder setting up on the weekly time frame, that we were coming up the right side of the shoulder, it looked like. Well, 2 weeks ago, we got slammed pretty hard. And this week, we continued a little bit lower is the GLD, which is the ETF, Exchange Traded Fund for Gold, was down 0.5% this week. So we lost that ground last week. We continued a little bit lower. We've got the 200-day, the 150 and the 200-day moving average right down near about 160. Perhaps we settle back down towards that level again before it's ready to rally. But I think that near to intermediate term, the next couple of weeks, that there's really no real advantage to being in gold. There's just no momentum there. So overall, I think the markets, again, had a constructive week. And if they can hold the lows in particular for this week, and if we can see maybe Apple settle down a little bit, it's really good to see, actually, that the NASDAQ didn't get slammed as hard as a lot of people think it might have, with Apple getting hit as hard as it did. But if we can settle down a little bit further in here and then get above these little levels of recent resistance, 66 to 66 and a half in the Russell, in the Qs, in the SPY, if we get back above that 143 and a half level, then we could be in for a decent year-end rally. So thanks for tuning in, everybody, and I hope you have a good weekend.